Introduce Lance Taylor, the Arnhold Professor of Economics at the New School for Social Research.
Well, thank you very much. If you don't know what the title is about, it refers to John Maynard Keynes, who was born in 1883, died in 1946, and was the dominant figure in economics in the 20th century, I think is a fair summary. Unfortunately, beginning around 1970, his ideas more or less passed into oblivion, and maybe I'll talk a little bit about that. But he certainly come riding back in force with the crisis, which began in 2007. So what I'd like to do is talk about Keynes's ideas and also try to relate them to the crisis, which is a fair bit for a lecture of 1 hour, but I will try to be relatively coherent. So just to begin, Maynard's macroeconomics. I'll say more about each of these topics as I go along, but there are sort of a few key ideas that one has to bear in mind. One is the notion of fundamental uncertainty, and I'll say something about that in a minute. The second is that Keynes drew a distinction between prices of assets on the one hand and prices of goods and services on the other, and that turned out to play a pretty fundamental role in making the crisis occur. He also postulated, basically, that national output is equal to national income, and the national income and product accounts, or the GDP accounts that you read about in the newspapers, are constructed to fit that identity, if you like. So the basic data that people work with was, in fact, shaped in a form that was invented by Keynes. There's an implication that investment, and by investment economists mean physical capital formation, is automatically equal to saving. And that is also built into the data, and I'll have something more to say about that. What that implies, in fact, is that output is determined by something called effective demand and not aggregate supply. Now, the kind of economics that supplanted Keynes beginning around 1970 essentially postulates that GDP is determined from the supply side. That is, in effect, it assumes that there's full employment of labor and capital, and this full employment of labor and capital generates the level of output. That is known as Say's law, or if you'll pardon my French, Say's law, after a French-Italian economist who sort of flourished around 1820. And certainly the recent events have demonstrated that Say's law is not valid. And that's another point that I want to emphasize. As I say, I'll come back to all these ideas as we go along, and they all have a role to play in determining or setting up the conditions for the crisis. There are also a couple of disciples that are interesting to bring into the discussion. One is an American named Richard Goodwin, who ended up teaching in Cambridge because he ran into problems with McCarthy around 1940, late 1940s, early 50s. And he said that there is a distribution versus demand cycle in the U.S. economy. That is, over the business cycle, you see a clear pattern of changes in income distribution and output, and I'll have more to say about that. And then there's an Englishman named Wynne Godley, who sort of took off from the idea that it's true that income is equal to expenditure or output across the economy, but for any actor in the economy, whether a person or a sector, however you choose to classify things, this actor can have income not equal to spending, so that in effect, if it's spending more than, if the actor is spending more than its income, then it's going to have to run up liabilities or borrow. If it's spending less than its income, then it's going to have to be lending. And there are quite interesting trends and cycles in patterns of net borrowing across the economy, and big shifts, as we will see, around 1980. Now, I use this fancy philosophical word, ontology, to describe Keynes's view of how the financial world in particular operates. And there's a distinction that one can draw between fundamental uncertainty on the one hand and what economists call risk on the other. And what I mean by risk is that if risk applies, you can put a complete probability distribution on all future events. And most microeconomic modeling is based on the assumption of risk. Now, Keynes and other people argued that you really can't put a complete probability distribution on future events, in part because you can't even think of them, you can't even conceive of them. And there are plenty of ecological examples of that. Easter Island, the CFCs in the ozone hole, and people on Easter Island, when they put up their statues, just really didn't realize that they would be denuding the forest, and after a while that would become ecologically impossible. Nobody foresaw that CFCs would create the ozone hole. Up until around 1946, or 2006 rather, Ben Bernanke, governor of the central bank, was talking about a great moderation. And he certainly did not, and possibly could not, have even considered the crisis that was about to break. And that's the kind of thing I have in mind by fundamental uncertainty. You really cannot know the future. Now, if that's true, and in particular, if you look at financial actors, and this is a key theme in Keynes, that financial actors essentially base their decisions on conventions, which may be stable for a time, but then can change quite rapidly. He had a metaphor about that, which he called a beauty contest. Now, that's not the attempt to, that's not choosing Miss Mary Old England of 1936 or something like that, but rather English newspapers in the 30s had contests in which they put up printed pictures of a dozen or 15 or whatever young women and asked people to vote on not who was the prettiest, but rather who the voting population would say was the prettiest. So essentially, you were trying to figure out the person that people would think was the prettiest girl, as opposed to just the prettiest girl who was being shown. And then Keynes argued that in financial markets, then you can take this up into a number of degrees. What will the main people think is, who will the majority of people think is the prettiest of the prettiest? And then you can get to the prettiest of the prettiest of the prettiest, which is anticipating which way, if you like, the second derivative of opinion. And Keynes went on to say that there are some people in financial markets who really proceed to the fourth or fifth degree of perception in this beauty contest. Now, if you think about it, if there's a little disturbance in the financial market, then you have people figuring that out, and then people figuring out what they are figuring out, and so on. So really, the beauty contest is kind of a magnification device for telling the group of financial actors as a whole which way the market is going to break. Keynes was actually fairly friendly with Wittgenstein, and in sort of Wittgenstein's later anthropological philosophy, he said that knowledge is based on social conventions. Keynes' view of the financial market is it also relies on social conventions, with the difference from Wittgenstein that they can change rapidly and unexpectedly. And we've recently seen an example of that. Now, if you look at the housing price bubble, for example, and I'll show you a picture of the bubble in a couple of minutes, expectations and the valuation models got built around a convention of steadily rising prices. And in fact, housing prices had been rising fairly steadily since the late 1930s with greater or lesser speed. But then they stopped rising in the mid-2000s, and the calculations fell apart. Simply, the valuation models for both housing mortgages and the derivative securities based on housing mortgages simply collapsed because they'd been built around an assumption of exponential growth, which is sort of fluctuating up and down. Now, there were diverse causes for the equity and housing bubbles, but certainly the financial deregulation and the emergence of something called finance theory were tremendously important. Finance theory, by the way, is a discipline that emerged around 1950 essentially saying you could put risk, it operated under conditions of risk, and in fact operated under conditions, under assumptions of a Gaussian distribution of risk. And the fact that, in fact, price fluctuations are not Gaussian is a major criticism of finance theory. But even worse, you can't put a probability distribution on the future. Nobody foresaw the break in the mortgage price growth, for example. And in that sense, the theory was very misleading. Now, so that's sort of one observation that we'll come back and bring into the discussion later. The second observation is that the capitalist economy has two sets of prices. That is, you've got a set of prices for assets on the one hand, that is houses and shares and bonds and things like that. And then you have another set of prices for goods and services. And when people talk about inflation, they're always talking about the growth rate of an index of prices of goods and services. Asset prices are left out. Asset price inflation is left out, or has been left out until very recently, of most discussions. Now, there's a notion called inflation targeting, which is sort of a grandson of monetarism, which says that what central bankers should do is raise the interest rate when the price inflation rate speeds up, and reduce the interest rate when price inflation slows down. Price inflation, for a variety of reasons, actually slowed down beginning in the mid-1990s. And that was one rationale for low interest rates, or one justification for the low interest rates that were applied at that time, even while you had asset price bubbles building up for equity and for housing. Asset price movements can be highly irregular, and I'll show you some slides in a minute, or I can show them right now. This picture shows indexes of the nominal and real S&P 500 stock market index. By real, I mean the nominal stock market index deflated by in this case, the GDP deflator, which is the most broad price index for goods and services. Notice that you get an asset price boom getting underway. Where does it start? It really takes off sometime in the late 1970s, early 1980s. You see that the equity price boom peaks around 2000. Then there's a break downward, which was associated with various things, for example, 9/11, and then some recovery. But even so, the real S&P, that is the solid line, lies considerably below the peak that it reached in the year 2000. But in any case, there was this asset price excursion that lasted, or this equity price excursion that lasted for about 20 years. Here you see the GDP deflator versus housing prices. Note that housing prices more or less tracked the GDP deflator up again through the early 1980s. A lot of things happened in the US economy in the early 1980s, as I'll come back and discuss. And then you start the housing price boom. It peaks in the mid-2000s, and then you get the crash. And again, this was unprecedented, but had been built into all the models. So housing price bubble breaks in late 1990s, housing price bubble in the mid-2000s. Now, the next theme that's important to bring in, which was in fact not emphasized by Keynes, but fits naturally into a Keynesian framework, is that basically, if you start participating in a bubble, the standard pattern, or the universal pattern, is economic actors increase debt to buy assets in anticipation of capital gains. Now, the way that people normally think about this is in terms of leverage. And I'll give you a formal definition of leverage in a minute. But basically, running up liabilities to buy assets in anticipation of capital gains goes back very far into financial history. The first widely publicized example was the Dutch so-called tulip mania, which occurred in the early to mid 1600s, around 1620 or so. Now the records are not all that complete, but basically people were borrowing on the margin to buy up tulip bulbs whose prices were rising, and after a while that crashed. There were major crashes in France and England in the early 1700s, and in fact Isaac Newton got into the South Sea bubble in England, got out, got back in again, lost a considerable amount of money, and said after that, I can predict the motion of the planets, but I cannot predict the madness of crowds. And that thought has continued until the present day. Now, there's also a concept of liquidity that turns out to be pretty important in this context. Keynes thought of liquidity as money. Now, basically, liquidity is, or money rather, is a liability of the banking system and an asset of the people who happen to hold money. And really by social convention, money is quote unquote always accepted as a store of value and a medium for transactions. That ceases to be true in hyperinflations, but that's something that I don't want to talk about much today. Now, what happens after a financial crash, of course, is that economic actors fall back on liquidity in the form of safe assets because they're really scared. And what happens after every financial breakdown, and they happen fairly frequently, is a flight to liquidity in the form of assets, and that has various consequences, which I'll take up in a minute. Now, for traders, however, on Wall Street and other such places, liquidity took the form of debt, which was a liability. And in effect, traders ran up debt to buy assets with rising prices. And as I say, this is a very old story. It was not very much discussed by Keynes, but certainly by Keynes and subsequent Keynesian economists, for example, people named Hyman Minsky and Charlie Kindleberger, who died, both died in the late 90s, early 2000s. I don't have the exact dates in my head. Now, so the simplest possible balance sheet, let's say, looks like that. On your assets, or basically you have some kind of asset with some kind of price, P sub A, and that is the positive side of the balance sheet. The other side of the balance sheet is either debt or equity, where equity could also be interpreted as net worth. Now, leverage, or the leverage ratio, if you like, is the value of assets over equity. Now, it's easy to see that suppose you get a, say, 2% increase in the price of the asset, so say you're at 100 and the price of the asset goes up by 2, so there's a 2% increase there. But if you hold debt constant for the moment, then equity has to rise by the same amount. But the percentage change in assets, therefore, is a lot lower than the percentage change in equity, which means that when the asset price goes up, leverage goes down. Or when the asset price goes down, leverage goes up. Now, the return to an asset is, if you think of shares, for example, and for the moment ignore dividends, although they're still somewhat important in the US economy. But if you think of shares, the return to an asset is the growth rate of its price. I guess Google hasn't got around to paying dividends yet, so the return to a Google share is its capital gain, and that's why people buy shares in anticipation of future capital gains. Now, fluctuating growth of asset prices was built into nearly all the valuation models from finance theory that were used by traders, which I mentioned before. But that turns out to be a pretty important aspect of the crisis. Now, as I mentioned, with stable debt, growth in the asset price means that leverage goes down, which is a clear incentive to run up more debt to buy more assets if you can get a hold of the borrowing power, and that was also built into the financial system. On the other hand, a decrease in the asset price means that leverage goes up, and pretty soon creditors close in. That happened quite clearly after 2007, happened quite clearly after the stock market crash in 1929, and it happens with some frequency in other events. So then, to try to restore their positions, traders start selling assets into a falling market, and so drive prices down further. So you get deleveraging, and a lot of people go underwater. Now, notice that this ties back to Keynes's view of financial markets as being driven by conventions, because if you have a convention that asset prices are going to rise, that's fine. But on the other hand, when that convention breaks, you can have extreme disorder and a highly, again, disorderly process of deleveraging. Moreover, I haven't put it into the slide, but I should. The 2007-2008 crisis was really characterized by the fact that people were using the same financial models, applied to the same data to price out the same derivatives. So there was an enormous amount of homogeneity in the market, probably more than had occurred in previous situations. And with all that homogeneity, the situation got noticeably worse. So the convention that asset prices keep rising falls apart, flight to liquidity. And then the crisis was exacerbated because mortgages had been securitized into things called derivatives, which is essentially a bond based on its component mortgages, and then sold on to asset holders. And these derivatives, credit CDOs, I can't remember, had been sold, the mortgages had been packaged together, sold on to asset holders in very complicated patterns. People were trying to evaluate the CDOs, collateralized debt obligations, using these models, since they were not heavily traded, and the fact that they were all using the same models applied to the same data and the data changed was a major contributing factor to the crisis. But there are financial crises all the time. I mean, just look back at recent history. You have the events of 2007, 2008. Before that, I can't remember all the events, but you had Enron, you had the Asian crisis, you had the Mexican crisis. Crises happen every 5 or 10 years. It's with some regularity. Charlie Kindleberger, whom I mentioned before, wrote a fascinating book, although a bit trying to read, called Manias, Panics, and Crashes, and he has this big table showing major crashes in capitalism since around 1800, and there's an entry in that table about every 10 years for the major crises, and there are a lot of other minor ones as well. So they happen all the time. Now, why did this latest one propagate to the real side of the economy? That's the key question. And again, one can fall back on Keynes and his followers to try to construct some kind of a model. Now, as I mentioned, Keynes postulated that output, which I will call X, is equal to income, which I will call Y, automatically. And he was willing to be flexible about how this happened, and it sort of drove a lot of people crazy by so doing. But the output equals income identity is built in, as I mentioned, to the GDP accounts. And so it was and these accounts were invented by Keynes around 1940. And they're basically the input into almost all macroeconomic discussion these days. So he's still hovering over us in that sense by setting up the accounts by which we all think. The simplest example, if output is equal to investment plus consumption, and if income is equal to saving plus consumption, then investment has to be equal saving automatically. And those are the basic identities, so to speak. Now, if consumption depends on income, which also means that saving has to depend on income, then you just do the algebra and you'll see that investment is going to determine the level of output. And this is the principle of effective demand. That is, demand is driven by certain injections. The other major injections would be exports and government purchases. And there are also leakages to savings and imports and taxes, and the calculus of injections and leakages is what underlies the principle of effective demand, which is all quite simple and straightforward. There's something called the paradox of thrift, if you think about it, that arises in this particular context. That is, if people try to save more, then in effect they'll be consuming less and reducing excess demand, so that everybody trying to save more is in fact self-defeating. This paradox of thrift is an example of something that's called the fallacy of composition, which also enters rather strongly into Keynesian economics. So that's effective demand. Now let me say something about distribution in demand, which begins to cut into the nub of the transmission of the financial crisis to the real side of the economy. In macroeconomics, the easiest metrics for an income distribution are the shares of wages and profits and income. And that's a terrible metric in many ways. But it's about the best that we can get our hands on for doing macro. You'd be much better if you could map the whole size distribution of income into some 2 or 3 simple categories, and some people have tried to do that. But let me stick with wages and profits for the moment. Or wage and profit shares, and those shares have to add up to 1, subject to a number of assumptions, which I could go into if you want to hear about it. Now, suppose we start out with labor productivity. And productivity is measured very crudely in all economics, or in all macroeconomics, as output over employment, or output per person hour, or some such measure. And economists like to babble about technological change and how what's going on in this sector or that sector. And when they do that, they're basically just talking about output over employment, which is a pretty stupid measure, but it's the one that we deal with. Now, as it turns out, productivity tends to rise when output swings up at the end of a recession. So this diagram, the recessions in the U.S. economy as monitored by something called the National Bureau of Economic Research, are shaded in. And as you can see, recessions don't last very long. The present one, which I suppose ended in the last quarter of 2009, was actually a fairly lengthy recession in terms of output. Employment is a lot worse. It's a lagging indicator, and that's one reason why unemployment is still so high. But if you look at output as the measure, this is the kind of picture you get. As you can see, productivity is this is log deviation of productivity from trend. And as you can see, productivity tends to swing up rather sharply as the economy emerges from a recession. The general idea is that firms are unwilling to hire on more people until they're pretty sure that the output is seriously going to go up, so that they keep their same labor force in the beginning of the upswing while output is rising, and therefore productivity, as conventionally measured, tends to go up fairly rapidly, and then, as you can see, it tends to drop off. Now, if you work through the algebra, which is not terribly difficult, you can see that the wage share is equal to the real wage divided by productivity. And there are productivity and wage share versus output cycles. The wage share tends to fall coming out of a recession because labor doesn't have much bargaining power. The real wage doesn't go up while productivity is rising, and therefore the wage share tends to fall. After a while, labor gets itself into a better bargaining position, and the real wage tends to rise. So that the falling wage share basically leads rising capacity utilization. And again, economists are always borrowing models from everybody else in the world. This can be rationalized in terms of a simple predator-prey model from mathematical ecology. The wage share is the predator, and capacity utilization is the prey. This idea, as I mentioned, was sort of formalized by Richard Goodwin. If you go read Volume 1 of Capital, you can see a pretty clear statement in Marx. Now, the interesting thing, if you look at the data, is that, so in this particular diagram, you see that the wage share is the solid line, capacity utilization is the dotted line. The wage, if you look across cycles, the wage share tends to fall as capacity utilization tends to rise. Then the wage share builds up as a predator, and capacity utilization peaks, and then you go into another cycle. Yeah? The question is, how do you define capacity utilization? And this is another economist sleight of hand. You essentially fit a trend to output, see what's going up and down. We pretend to be serious, but we really aren't. Now, the other thing you see here is that wage share fluctuations across the cycle take a big change after around 1980. That is, the reductions are much deeper and the recoveries are weaker than they were prior to about 1980. So that there was a fairly significant change in behavior of the distribution versus demand cycle, again, beginning 30 years ago. And we'll see other examples of that sort of pattern in a minute. The other side of the following, the other side of the falling wage share was a rising profit rate. The dark line is the profit rate, which is not that easy to estimate either, but notice that it begins to again rise sometime in the 1980s. And then, let's see, the solid line is a real short-term interest rate. The dashed line is a real short-term interest rate, and the solid line is a real 5-year interest rate. And basically the story there is that in response to the decade of stagflation between 1970 and 1980, the Federal Reserve had a shock increase in the interest rates. They all jumped up then, and then gradually tended downward with some fluctuations. Part of the reduction beginning in the late 1990s was due to inflation targeting that I mentioned. That is, the rate of inflation dropped off, and given their peculiar mindset, the central bank, Alan Greenspan, had no particular reason to try to increase interest rates. Now, the low interest rates, yes? Which chart are we? Shifted to the right? Yeah, they are. Okay. Just shift them back. Sorry. I'll have to take that up with my RA, who does this kind of stuff much better than I do. Okay, now the interest rate reductions. There was a guy an Austrian economist named Hayek, Friedrich von Hayek, who was actually a pretty close social friend of Keynes, although they disagreed about many things. And Hayek emphasized that low interest rates could feed into asset price bubbles. That was one of his major ideas, which, as I say, was not something that Keynes thought about very much. But I think it's fair to say that low interest rates certainly were a contributing factor to the bubbles, but I think financial deregulation was probably more important. And here you have an experiment, if you like, in the sense that Canada had the same low interest rates as the US, but did not relax regulation, and they avoided the worst aspects of the crisis. And that's about as close to an experiment as you're actually going to get in macroeconomics. Now, as I mentioned, for any individual or collective economic actor, net borrowing is equal to expenditure minus income, which in most cases is equal to investment minus saving, which is in most cases equal to a demand injection minus a demand leakage. At the same time, the sum of net borrowing flows across all actors must be zero, so that the accounting built into the national income and product accounts can be satisfied. Now, if you take a look at the data, so what we did was put together data on net borrowing for US households, business, government, and net borrowing from the rest of the world, which of course is the same as net lending to the United States. And first, if you look at the first graph on the upper left, you see that household net borrowing was in fact negative until around 1980, which means that households were basically lending to government and to business, which is a fairly traditional pattern. Then, if again around 1980, it started to trend very rapidly upward with some fluctuations. And then, of course, with the onset of the crisis, broke downward as households got wiped out, basically, and had to try to reconstruct their balance sheets. In the upward trend, beginning around 1980, underlying the upward trend was the share of consumption and income rose by about 10 percentage points, which is a lot. And that is, it went, the share of total consumption and income, is, if I remember the numbers correctly, went from something like 80 to 90%. And most of that, if you decompose it, was due to rising healthcare costs, which in that sense had a major impact on the system. The counterpart, then, that shows up in the lower right, and that's not very clear, I hope you can see it, was falling net borrowing by the rest of the world, or rising net lending to the U.S. economy. Now people talk about twin deficits, and during the Reagan period, there was a lot of discussion about how the federal deficit was driving the external deficit, and all you had to do to get rid of the external deficit was to reduce the government deficit. The president of my university happened to be a senator at that time, and he sort of talks about how they told us all we had to do to reduce the external deficit was cut the budget deficit, and we did, and nothing happened. So that shows you what economists' advice is worth. The real twins in this data, at least, were the private household consumption deficit and the foreign deficit. To a degree, that pattern reversed after the crisis, as I mentioned, that household borrowing dropped off, and also net lending to the U.S. declined if you turn the diagram in the lower right upside down. Another observation that comes out in the data is that government net borrowing tends to be countercyclical. That is, during the recession, tax collections go down, unemployment insurance goes up, et cetera, et cetera. So that forces the government to borrow more. So the government, in fact, stabilizes the economy, which is an old idea, which has been around for a long time. This diagram shows, if you want to spend a few hours looking at it, shows all the patterns superimposed, and I think I'll just skip over it. Now, so what you see then so far is a change in distributive patterns beginning in 1980, and a change in net borrowing patterns at about that same time. Now, the next thing is a lead-in to trying to make a bridge between the financial and real side. The next thing is to bring in a little bit of historical background. Going back really to the end of the First World War. By the way, Keynes first made his reputation he was a delegate to the Versailles Conference for a while, and then went home and wrote a book called The Economic Consequences of the Peace, which was a devastating critique of the reparations that had been imposed on Germany. And that became an international bestseller and made him famous. And he didn't look back after that. It's still worth reading these days, particularly for the nasty comments about the leaders of the discussion at the Versailles negotiations. In any case, beginning around 1928, you had rising income inequality in the US and throughout the world. In the European sense of the word, it was a liberal period, and that ended up in the Great Crash, which was based on a run-up of leverage, particularly after around 1927 in the stock market in New York. 1929 to 50, you get a whole series of events: the Great Depression, the New Deal, which imposed very heavy financial regulation, World War II, and recovery. 1950 to 1970, in retrospect, is sometimes called the Golden Age, because it was really the best 20-25 years of economic performance worldwide, both in the advanced economies and in the rich countries and in the poor. It was characterized by the creation of the welfare state, the Keynesian consensus, and, as I say, fairly good economic performance. 1970 to 1980, you get stagflation, oil shocks, loss of post-World War II US hegemony. 1980 to 2007, you get another liberal resurgence, heavy financial deregulation, emergence of finance theory, and big changes in inequality over these periods. That is, the numbers here come from income tax data, which has been compiled by a couple guys, put together by a couple guys up at Berkeley. In 1929, if income includes realized capital gains, then in 1929, 22.5% of income was in the hands of 1% of the households. That fell to 9% in 1979 and was back up to 22.5% in 2006, which is a very major shift in terms of distribution, and is reflected in the wage share and profit rate data that I presented earlier. Now, you then get various trends going together. We noted the trend decrease in the wage share. That's the solid black line across cycles, and it pretty clearly goes down. There was a big increase in the consumption share of income, which is the dotted line, and that's what underlies the patterns of net borrowing that I was discussing above. And then you get a big increase in household real debt, which sort of begins to go down with the beginning of the recession. Again, these are major breaks that occur mostly after 1980, at the same time as the liberal political economy resurgence got underway. And you've got some pretty strong trends here. And one of the few things that you know in economics is that trends can't go on forever. Something has to break. It's fairly clear that they broke around 2007, 2008. Now, the collateral for the debt, of course, was rising equity and housing prices. And household borrowing was eased by falling real interest rates. So you see the real medium-term let's see, what do we have here? We have real debt, which is the dotted line, that the one that's rising, the one that rises the highest, which was accompanied by real housing prices, by a rise in real housing prices. Note that there was overshooting, which often happens in financial crises. That is, the real housing prices broke downward before real debt began to break downward. So somehow people hang in there for a little while after the asset price booms, after the asset price boom stops. And of course, this was accompanied by steady decreases in the real rate of interest. Again, trends which could not persist. Interestingly enough, households were rational in the sense that their debt to net worth ratio, which is the dotted line, stayed fairly stable until, of course, the denominator, net worth, went down because asset prices went down. And household expenditure to net worth actually declined. So if you like, households were being somewhat rational, or behaving rationally, ninja mortgages and all, perhaps thinking that household prices would tend to trend up forever, but in fact they did not. So those are factors that help contribute to the crisis. Finally, after World War II, the U.S. had a very strong external surplus on trade and a rising surplus on interest and dividends from abroad or factor income. The trade surplus disappeared around 1980. And Japan, Germany, China, and OPEC essentially picked up the surplus position. So global economic flows became highly unbalanced. And I have some tables here which illustrate that, but I think I'll skip over them since you probably can't read them anyway. If someone's curious, we can talk about them later on. So just to try to sum up, you get 9 interacting sets of events. One being the major shift in political economy after 1980. The second is that the real interest rate and wage share trended downward after 1980 across business cycles. The profit rate and household borrowing trended up. These trends cannot continue forever. The ratio of household debt to income doubled, which again is a really major change. There was an equity price boom from the early 80s to the late 90s. Thereafter, returns to equity were flat or negative. The housing price boom peaked around 2006. Asset price bubbles allowed households to maintain consumption even with rising inequality. That is, the way that most people essentially paid to keep their level of spending up was to borrow. And again, the borrowing was made possible by the asset price increases. The twin to the rising household borrowing was foreign trade surpluses. And you can see that clearly in the data, although I tiptoed over it. Falling real interest rates probably supported the bubbles, but light touch regulation was probably more important. And then again, the US versus Canada comparison is quite interesting. And the light touch regulation was again rationalized by the emergence of high-tech finance theory. Keynesian macroeconomics, as part of the liberal resurgence, had been supplanted by Say's law in the eyes of the profession. And so people just didn't really think anymore about professional economists, particularly, so to speak, up the road a little ways, if that's up the road, and the other major universities, simply forgot everything that Keynes had to say. And that was more or less a conscious process. I could go into the history, but that would be another whole lecture, and so I'll spare you. Now, the factors that I mentioned, 7 through 9, essentially the ones on the finance side, supported the mania, panic, and crash. And again, this is nothing new in historical terms. You get a crash every few years. Why it propagated to the real side of the economy had to do, I think, mainly with shifts in household behavior, aided by the asset price bubbles. When the crisis hit, aggregate demand collapsed, Household net borrowing collapsed. Since output is determined by demand, you got a major recession. And evidently, Say's law was not enforced. Global trade and financial flows have adjusted to an extent to be consistent with the crisis in the US. They basically had to, because accounting across the world has to add up. And the changing political economy environment made the whole thing possible. Now, I don't think Keynes or anyone else could have foreseen all the complexities of the crisis that would emerge. But I would argue that the only way you can really think about the crisis historically, and economics really is an historical science. We can try to unravel things after they occur and maybe say a little bit about what's going to happen in the future, but not very much. And the framework, intellectual framework provided by Keynes, I think, is the only one that allows us to try to figure it out in a consistent body of theory. And that, of course, is a source of his revenge. After being forgotten for these many years, he turns out to have been correct in much of what he said. Not all, and other people said things, as I've emphasized, what goes into the story. But they were all Keynesians, and I think in that sense, Keynesianism, or Keynes, has been vindicated. Well, that's what I have to say. Questions? Are you convinced? Yeah. Do you want to use the mic? Or? Oh, it's too much work. Okay, the question is, what is the next good thing and the next bad thing that might happen? I can try and answer it, but let me just preface the answer by saying that Donald Rumsfeld was a Keynesian, in the sense that, he talked about the known knowns and the unknown knowns, or the known unknowns and the unknown unknowns, which is very close to fundamental uncertainty. And there's really a lot we don't know, particularly right now, because the unknown unknowns, the things we can't conceive of, are likely to determine the outcome. Now, that being said, the positive development, so to speak, would be, if I can get back to the net borrowing picture, which is a ways back, notice that how household net borrowing breaks downward with the onset of the crisis, and in fact, it's getting down toward the levels of it's not there yet, but it's toward the levels that ruled prior to 1980. So if households manage to swing themselves back, and they may or may not, but if they manage to swing themselves into a position of actually being negative net borrowers or net lenders to the rest of the economy, that could provide a mechanism to bring the external account back into balance if the government, which the government eventually will have to do, also manages to get its fiscal situation back in balance. So the positive outcome could arise from essentially rebalancing the US economy internally. Now, that would have to be accompanied by a rebalancing of the global economy externally. And if you like, a major bad possibility is that is not going to happen. That is that Germany and China in particular, as the major exporters, will not find it feasible or convenient to swing their economies in the direction of generating more internal demand, and in that sense, bringing the world back into balance. So, most of the discussion these days centers around the international situation. You pick up any newspaper in the U.S. any day, and somebody is going to be berating China for its exchange rate policy. But I think if the U.S. still has enough hegemonic power to affect the world, if in fact it gets its internal situation in order. I guess that would be the answer. Yeah.
Hi there. So I guess my question was related to the borrowing of households, which you started to answer. I was wondering if there's a way, like to sort of soft land that trend. And I am wondering, what's the relation of the household's debt, so to speak, to the assets they hold in, like 401ks and, like other types of investments, which are not counted, I guess, today as savings. I mean, as typical savings, like like a money market account in a bank or something like that.
Well, I mean, your contribution to 401k certainly is saving, that in national accounts terms. The ratio of U.S. debt to net worth, I could probably, no, I can't pull it out here. Maybe I can. Is that diagram here? Real debt. U.S. debt to net worth is the dashed line on the left scale. And as you can see, as a number, it's not all that high, because the U.S. household sector actually has a lot of net worth in the form, roughly, off the top of my head, roughly 30–40% in terms of housing, and the rest in terms of financial assets. So in that sense, households are not highly leveraged. But on the other hand, leverage went up quite strongly with the fall in asset prices beginning with the stock market and then with the housing bubble. Now, the decline in net borrowing or negative net borrowing means that households would gradually be building up their net worth, but the real cause of the swings in net worth are the asset price bubbles, and it takes a lot of net borrowing to offset the fall of an asset price, I guess. So I expect that households will be in a bad budgetary situation for quite a while, which in a way is not a bad thing. I mean, the U.S. really should be saving a lot more than it is.
Thank you.
So a few slides ago, you asserted that Say's law had been determined to hold. As
been determined or not determined?
Well, you said that it had been not determined in your post-mortem analysis,
Yeah.
but in your causal factors, you listed that as one of them.
Yeah.
I was I don't understand where you say that Say's law was determined to hold, or to be thought to have held.
Well, I mean, well, the short answer, I guess, comes from Candide. That is, economists like to believe that we're living in the best of all possible worlds, and most of the thrust of conventional macroeconomics essentially says that the economy is going to tend toward a quote-unquote efficient position, where all resources are utilized optimally and that kind of thing. And evidently, you can't have a lot of unemployment if all resources are being used optimally. So economists are really brainwashed into thinking this kind of thing in their graduate education. You should ask your chief economist to give you a lecture about why that's not true. Yeah.
Hi. So it seems to me that one of the major confusions about Keynesian economics is that once one accepts that premise that one is to intervene in the economy, then the natural next question is just how much intervention is the right amount. So without getting too much into policy prescriptions, it seems, depending on how you measure it, that the balance sheet of the Fed has been increased by some 33% or so. And
more than that.
Let's try to be conservative. So let's say we buy into the notion that all the right things are being done. Then what can we expect? China may be growing at like 9% or so annually. So let's say something on that order of magnitude still results in excess, in the monetary base of on the order of 25% year over year. What is your comment on that? Is that too much? Is that healthy? what to make of that number?
Well, let me answer in the following way. I think basically, if you want to avoid a major recession or avoid a depression, given the reduction in investment and the increase in saving that followed the financial crisis, basically the only way you can maintain aggregate demand at some level is by using some combination of fiscal expansion, which the Obama package did. I would argue it was too small, but anyway, they did what they did. And monetary expansion. That's for aggregate demand. At the same time, if you like, Wall Street managed to shoot itself in the foot so dramatically that basically the financial system was in grave peril of collapsing. And the only way that you can avoid that is by throwing a lot of money at Wall Street, which they did very enthusiastically. The expansion of the Fed balance sheet, which before the crisis was running, on the order of 600 billion, something like that, and is now something like 2 trillion, that was a consequence of expansionary monetary policy to try to bail out Wall Street. Sooner or later, they're going to have to mop that up. And there are various technical ways that one can think about doing that, which they're beginning to dabble with at the moment. But the Fed ultimately is going to have to shrink its balance sheet, and that's also but that will create problems with availability of credit to the real economy. So it is a whole can of worms. And I think if those interventions had not happened, we would now be in a depression. There's no question in my mind about that. And then the real issue is how to gradually unwind the interventions, get the fiscal deficit down to say, I could go back, I can't remember the exact number, we could go back and look at it, shrink the fiscal deficit by something like 6% of GDP, and hope household borrowing stays negative, so lending is positive, and there is some possibility of a soft landing, but I wouldn't count on it. Is that
so it seems that you're saying what has been done was the least of all evils, but my question still is, so let's take this pair of numbers, you go from 600 billion to 2 trillion over more than a year, but whatever. How do you know where to stop? I mean, if that's been such a good thing in the sense that it's been the least of all evils, why not continue doing it?
Well, it hasn't erased all evils. I mean, I'm not going to defend Goldman Sachs, for example, but Goldman Sachs and Citibank, for God's sake, and the other banks were major beneficiaries of this intervention. They're so interconnected with the rest of the economy that had the monetary intervention not happened, then we would be in a real mess. If you look, by the way, look at experience in developing economies who have specialized in this kind of event, when their banking system falls apart, you find that to rebuild the banking system takes a pretty significant chunk of GDP, like 20%. And the U.S. is getting up in that range. We're in the same ballpark. As I say, I don't think you have any choice but to do it. But that doesn't mean it's a happy process. And stopping where we have stopped, if we are indeed stopping, I think is probably a good thing.
Thanks.
So I pulled all my investments into cash back in 2004.
I don't give financial advice, although I did more or less the same thing.
Yeah, well, that was back in 2004, but it took 4 years for the crash to occur, and I was this close to doing something very bad, investing into the stock market. So for the current sucker rally, any idea how long it will take before it crashes?
I think I'll pass. Regrettably, I honestly don't know. Well, thank you very much.